Just when we thought it was safe to go out looking for mortgages, this happened. Now you'd think that if the Bank of England cuts base rate, mortgage rates would follow. That's what we've been led to believe, isn't it? Every time it looks like the Bank of England are about to cut base rate, the media launch into their stories about what this means for homeowners with mortgages and how it can only help them as rates come down. The usual story is that it will particularly help borrowers who are coming off a fixed rate in the near future. But as I alluded to a few weeks ago, this isn't the full story, and unfortunately real life isn't quite so neat and tidy. Bank of England base rate and mortgage rates aren't 100% correlated or connected. So despite what the press may say, what you pay for your mortgage isn't always decided or affected by what the Bank of England do with base rate. Now don't misunderstand me, some products are linked to Bank of England base rate. You'll see variable rate mortgage products where the rate paid will be linked to base rate. For example, something like base rate plus X%. And you can fill in the gap. But at the moment, a typical product like this seems to be priced at something like base rate plus 4% or base rate plus 5%, or even more, of course, depending upon the lender and the other terms of the mortgage. The thing which the press don't mention, and maybe it's because they don't understand or they just don't have the time or even the space in the media to cover it, but what they don't mention is that many mortgage products are actually funded and priced on the international money markets where the Bank of England, and other central banks for that matter, has very little direct influence. Again, as I mentioned a few weeks ago, as I understand it, and don't get me wrong, I am no expert at this, it's more to do with Treasury bond and gilt yields, which in turn reflect how much appetite the market has for taking on government debt. That's what prices money on the international money markets. And at the moment, the market isn't convinced that inflation's under control, and it's not convinced that many governments can actually afford much more debt, despite the fact that many governments are still creating debt, and so rates are rising. And this is why I almost spluttered over my morning cornflakes the other day when one of my lenders messaged me, reminding me that one of my buy-to-let mortgages is coming up for renewal in January, and telling me I can switch to one of their fixed rate products at a rate of around 5.5%. That in itself isn't great now that we're used to much lower rates, but the reason for my choking fit was the casual way that they ended the message with the news that the reversionary rate payable after the fixed rate period ends is over 8%. Yes, over 8%. I haven't seen buy-to-let rates at that level since the early 2000s. A few days later, I had an interesting conversation with my account manager, who informed me that this particular bank had increased rates across their buy-to-let range by 0.25% since the Bank of England had reduced base rate by 0.25%. Now, of course, things change, and if maybe inflation is tamed, or if there's a recession, or both, and both are possible, by the way, over the next couple of years, mortgage rates may come down again to a more manageable level. Maybe in a couple of years we'll look back at all of this and laugh. Maybe. We can hope, can't we? But in the meantime, if you, like me, are getting to the end of a fixed rate period, or if you're coming to the end of a mortgage term, you will also need to negotiate where you go from here. Because despite the press media's optimism that the Bank of England cutting rates will make everything okay, that isn't actually the case. We already know that the budget could result in rates staying higher for longer. And on top of that, the latest inflation reading came in hot as well, meaning that even if the Bank of England were able to directly influence mortgage rates as much as people, i.e. the press, assume, their influence will be limited anyway, as their ability to cut rates is limited. By the way, and somewhat tangentially, even as I write this, Sky News have reported this morning that 6 banks are being called out for raising mortgage rates whilst cutting saving rates at the same time. You can't have it both ways, banks, but no doubt they'll be using the excuse that the Bank of England are cutting rates to cut the saving rate, whilst at the same time pricing their mortgages on the international money market rate. There you go, that's what they do. But for me, all of this shows the importance and value of taking proper advice from someone who knows the buy-to-let mortgage market inside and out before you buy or before you refinance. So if you'd like to talk to my very good mortgage broker about buy-to-let finance, or any other aspect of property finance for that matter, whether it be bridging finance or development finance or whatever, I'll be very happy to put you in touch. Just email me, thepropertyteacher@gmail.com. That's thepropertyteacher@gmail.com, and I'll be very happy to make the introduction.